My name is Patrick Allen. I'm a licensed realtor in Keller Williams, Southern Arizona. And in today's video, we'll be discussing real estate. The local Tucson housing market is getting hot. After 3 months of uniquely loud economic headlines and a national banking system that was beginning to show its first signs of weakness, we find ourselves now entering the peak summer months of traditional home sales. Now, the statistical tug of war between low affordability pushing against low inventory that we saw in January continues to drive buyers and sellers apart from one another. And the question buyers are increasingly asking themselves right now is, should I buy now or wait for prices to potentially fall later on in the year? In today's video, we're going to take a look at the data. I'm going to highlight 3 market stats that you need to know to get your head around exactly how the Tucson housing market is behaving. Whether you're here to learn about rates, rentals, or just your return on investment, this is your Tucson housing market update for the second quarter of 2023. Welcome back to a very special Patrick Needs a Haircut Pretty Soon edition of My Fi Life. Hello again, fellow investors and data junkie weirdos alike. We are back for yet another look into what our local housing market is doing right now. And while I am totally game to help answer this question for you all over the next 10 to 15 minutes, before we jump headlong into the current data, I think a short look backwards is in order. Quick rundown into exactly where our global economy has been over the last 12 to 15 months. And to that, I now turn to a series of data points that I snagged from the Mortgage News Daily app. And I've also included a link in the description for you to download the app for yourself. I find it to be an awesome free resource that makes it pretty easy to compare current mortgage rates to what was being reported 1 month, 1 year, and even several decades. And so let's now take a look at where have we been. Looking at the major trends, we can see that 2022 was a very busy year with respect to movements in mortgage rates. Simplifying things just a little bit, we can see that the close of the last business day in 2021 would also be the last time that we would see mortgage rates under 3.5%. And over the first 1 to 2 quarters of 2022, we saw rates begin marching up, steadily increasing from the low 3s to some semblance of stability in the mid 5% by the second week in May 2022. And after some initial volatility over the summertime, and with the added benefit of hindsight, we can see that rates were essentially flat over the summer months and through September, before jumping again from 5.5% to over 7% by early November. And then after falling basically 1 full point over the holidays, we started 2023 in the mid 6% range. And the bond market has essentially been fighting it out ever since, with rates climbing as high as 7% and falling to as low as 6.25% over the course of the spring months. It has made for the first semblance of a more normal, more stable resale market than we have seen over the last 4 years of post-pandemic financial policy. And so although the cost to borrow money is certainly higher than what it was this time last year, that decreased affordability seems to have only tamped down rather than completely eliminated the pent-up demand for housing from the millennial demographic, as well as Gen Z buyers beginning to enter the market to buy their first home. And so with all of that in mind, let's now turn to what I feel is the #1 most defining statistic in today's housing market. Stat 1, inventory of homes for sale. So when we last looked at this number in our first quarter video, we were putting into context the year-over-year trajectory of the housing supply. Now, while it felt somewhat alarming to have 2 months of inventory for sale last year, a figure up more than 100% compared with the prior year, we had to zoom out a little bit to see that our market was, in fact, showing signs of repairing itself from a period of aggressively low inventory that we saw through basically all of 2021. 3 months later, and looking at this same information, we can see a clear trajectory which is rather opposite to what we would want to see in the spring season. As of April's numbers, the Tucson housing market has clocked 6 months in a row of seeing a decrease in our inventory levels. Now, historically speaking, we can expect to see a more robust increase in the number of new listings coming to the market in January, and the number of homes for sale at any given time increasing steadily during the spring months to match the increase in demand and in pricing. that we usually see in April, May, June, and July. And so at 1,676 homes on the market to attempt to satisfy the demand of all of Pima County, it helps to explain why we have not yet seen a significant negative trend in our median home price. And so if you're a buyer, that's the bad news. But there is some good news, and that news lies in the second most important metric. Stat 2, days on market. At 47 days on the market, it takes literally twice as long to sell a home than what we were seeing last year. The crazy number of bidding wars, which largely pushed the first-time buyer out of the market for years, finally stopped being the case as we exited the third quarter of 2022. 47 days on market feels pretty high when we look at the histograms of the last 2 years, but again, when we zoom out, we can see that our market has pretty comfortably settled into the 45 to 65 DOM range for nearly a decade going into the pandemic. We can call this the first true signs of life for traditional home buyers and local investors. A higher DOM allows buyers more leverage to negotiate for seller concessions to help with rate buydowns, as well as to help identify needed repairs to be done before the new owner takes possession. And so even if the number of options of homes for sale remains relatively low, there at least is increasingly the luxury of time. And although we are expecting to see days on market fall a bit more as we enter the summer sales peak, and should mortgage rates continue to decline or towards the end of the calendar year, we theoretically could see days on market compress even further. And so while currently qualified buyers are in a reasonably strong position to negotiate for their interests in the second quarter, it very much remains to be seen whether that will continue to be the case by the time our October update comes out. And because I limited myself at the start of this video to only the 3 most important market stats, I'm not going to talk too much about the median sales price. There really isn't any time in this video for me to mention that a median home sales price of $375,000 means that we have not seen any sort of sticky decrease in year-over-year pricing. And at worst, month-over-month price changes seem to line up with traditional seasonal shifts that we always experience this time of the year. No, the third most important metric that to explain exactly where we are is, in fact, stat 3, closed sales. In my last video, we saw a new record low number of homes being sold over the holiday season of 2022. Now, while it's pretty normal for our market to see a drop in home sales towards the end of every year, the market bottom of 631 homes sold in January was the lowest that we have seen this figure descend to since January of 2008 and 2009. However, that stat was balanced with a touch of optimism, as we were already seeing the number of pending sales showing signs of recovery in January's data. 3 months later, we can see that the number of closed sales has recovered a bit, but not quite cracking the 1,000 closed listings in a month threshold. Historically, our market has come to expect anywhere from 1,100 to 1,500 homes being sold every single month, and this number tends to reach its yearly peak in the summer months of June and July. Comparatively speaking, the Tucson housing market can best be described as seeing a relatively small number of transactions occurring, a very natural consequence over the high mortgage rates we discussed earlier. Now, it will be interesting to follow this number as we get deeper into the summer months, not to mention of the fall and winter, and as we get a more sense of how the overall economy is going to be performing. And so now that we have a clear picture of what the data is telling us, it's time for everyone's favorite segment. I will now turn to my crystal kickball and see what predictions it holds for the future of the Tucson housing market. Okay, let's see if I can get this thing to work. Kind of a new purchase for me, so let me see. Okay, that was pretty cool. Helpful. So the way that I see it, there are 2 routes towards greater affordability in housing this year in Tucson. Number 1 is if we see a decrease in the spread between mortgage rates and the 10-year Treasury yield. So due to a high degree of unpredictability regarding with how the Federal Reserve will handle monetary policy over the next 3 to 12 months, over the last year or so, mortgage loan originators have essentially been including a surcharge above the 1.5% to 2% difference, which we typically see between these figures. Today's spread of approximately 2.8% suggests that in a more normal, more predictable market, that mortgage rates should be closer to 5.5% or maybe even 5.25%. And so the theory holds that as inflation reports show expected improvements over the summer months, and as the Fed pivots from a policy of consistently increasing rates to more of a wait-and-see approach, it seems feasible that this spread will decrease in the third and fourth quarters and might equate to as much of a 1 or even 1.5% improvements in prevailing rates. Of course, this is all gross speculation on my part, and a much better resource for this type of information would come from your favorite local lending partner or go-to mortgage broker. Now, the second route towards lower mortgage rates is a bit of a higher price to pay for this greater affordability. It is currently the position of ITR Economics, which is one of my preferred resources for macroeconomic data and trends forecasting, that we can expect a mild to moderate recession in the USA as well as globally in late 2023 and entering into 2024. Historically, recessions tend to exert downward pressure on mortgage rates, as stock market investors increasingly see poor expected future returns and therefore buy bonds instead. These provide essential cash flow even in bear markets and allow long-term investors to limit the hit on their portfolio caused by a drop in stock value. And so, due to the same forces of supply and demand which affect the local housing market, this functionally lowers the rate that you borrow for your mortgage, because it also pulls down the yield on the 10-year Treasury note we were just talking about a moment ago. And so while there are certainly routes forward over the next 6 months which could push things in the opposite direction, it's not at all impossible to think that we will see further rate hikes and even higher mortgage rates if the Fed wills that to happen. However, the market seems to very much want the opposite. And as we are just now beginning to enter the 1-year anniversary of the huge pivot in Fed policy regarding combating inflation, it seems to be at least quite feasible that we may see mortgage rates continue to moderate throughout the year. And if that does come to pass, then we can expect to see a reignition of the demand side of things, leading to lower days on market, a return to significant increases in the median home price, and any leverage today's home buyers might have will once again shift back to the seller as multiple offer scenarios become more prevalent. So that's my take on things. Let me know what you think down in the comments. Are my 3 stats actually the most representative of our current market, or am I leaving something out? We'll see you again in another 3 months to review what the summer peak looked like here in Tucson. I hope you all found this information useful or motivational. Or if not, I wish you the best of luck in finding your remote control before another one of my videos plays automatic. Whatever the case, my name is Patrick. I'm based here in Tucson, and this has been my file.